Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Hi, good morning. September 14th, middle of September, and as usual, there is a lot to talk about. So moving on to markets, again, September 14th. I'm going to talk this morning about a book that Bill Finkelstein had brought to my attention regarding poker, entitled The Biggest Bluff. Maria Konnikova wrote this book, and I think that there's a lot of parallels between poker and investing, and I'll discuss those. Then we'll talk about the financial markets, so what's going on this morning, Barron's latest thoughts on the financial markets. We'll turn it over to Brad to give us some more insights into the markets with an emphasis on the fixed income markets. So starting out with The Biggest Bluff and thinking about a card game, poker, and if you start really delving into the thought process, what you may discover is that there are lots of parallels between poker and investing, and perhaps that's one of the reasons why some of those who really enjoy participating in the market also enjoy the game of chance, but a game that involves a lot of skill, which is poker. And in both situations, what you find is that very smart people can often make very poor decisions or can have, in the short term, very poor results. But if there is significant skill involved and you are skillful over the long term, you should shine and should outperform the general crowd, and that's true both in both endeavors. But one of the things that investors make a mistake doing, and poker players as well, as the author points out, is that we all overestimate the degree of control that we have over certain events. Smart people who excelled at many things, people who should know better, often overestimate the degree of control that they have. They often decide ahead of time. If you think about investments, they decide ahead of time how they're going to divide their investments, often without giving a great deal of thought to the investment process. And they often do it based on incredibly little information, and this is a recipe for disaster. And this is something that the casual poker player may do as well. They may sit down at a poker table and start playing and not focusing on who they're playing against, what their playing style is, what the cards that have already been placed on the table say about the events, and think that it is strictly a game of chance, and that somehow they have some insight into this game based on their gut or their instincts. And this is a similar mistake that people make in the financial markets. And this goes to the point that humans, wired into our DNA, often think that we have more control over events when we are playing with something that has an element of chance than we actually do. Study after study shows that people fail to internalize numeric rules. They make decisions based on things like gut feelings, as I said before, intuition, what feels right, rather than based on the data that they are shown. We often ignore the numbers in favor of our own experience, what we have personally experienced, even though that is not necessarily something that the broader populace has experienced. And some examples of how people may make decisions based on their own personal experiences, not that they're necessarily bad decisions, but nevertheless how their personal experience, they think, resonates to a much greater extent across the overall universe. So, for example, after Hurricane Sandy in the Northeast, many people saw friends, family, or perhaps themselves impacted by the flooding, and suddenly many who had previously showed no interest or had shunned interest in flood insurance suddenly saw the light and felt that purchasing flood insurance was a good idea. So here we have a situation, some personal experience influencing a decision-making process. The decision-making process on whether to purchase flood insurance should have been made long before and independent of that event. Another example is those who lived through a 9/11, whether you lived in New York or D.C. If you lived through an experience and were close to a 9/11 horrific event, then you're feeling that there will be another terrorist event, or you're feeling about the incidents and occurrence of terrorism will often be greatly exaggerated relative to the probability that terrorism actually will take place. Finally, in the investment world, many who have shunned long-term care, advisors who talk to their clients regarding health insurance and long-term care insurance, often experience events that clients are reluctant to consider long-term care insurance. The cost is prohibitive, which it is expensive, but when faced with a parent or a loved one or a close personal friend who's going through an event that is either utilizing long-term care insurance or is eating through their savings, suddenly that event has a meaningful impact on their decision that long-term care insurance now makes sense. Again, it may or may not make sense, but the decision-making process being influenced and affected by personal experience rather than cold, calculated analysis of the facts. We don't often question the role of chance in the moments it protects us from ourselves and others. When chance is on our side, we disregard it. It's invisible. But when it breaks against us, we wake to its power. Example being, you're crossing the street, you forget to look one way, all of a sudden a car screeches on its brakes, and in that instant, in that moment, your life is saved by 2 inches because that driver was attentive enough to slam on their brakes. We think about it for 30, 60, 90 seconds. Maybe we even think about it for the rest of the day. That event could have changed our lives, and we don't give it a lot of thought after that. We don't think about the role that chance played in that event. But in the terrible situation where that car hits us, and we're out of commission for 6, 12, 18 months, we wake to the power of chance. If only that person had slammed on their brakes 3 seconds earlier, 5 seconds earlier, we all do this in our minds. Suddenly we recognize the power of chance and how dramatically impacted our life would be if only the chance had happened somewhat differently. Some of us imbue probability with emotion. It becomes luck, chance that has suddenly acquired a valence of positive and negative, good or bad luck. Again, we view chance as something that's happening to us. It's our good luck. It's our bad luck. It is not cold, calculated probabilities of the universe. Poker, like investing, stands at the fulcrum of the balance between those two oppositional forces in our lives, chance and control. It's an endeavor that involves both an element of chance, where a good player on any given hand can lose to an amateur, but because of control and predetermined rules and being able to focus and study the cards and the table, those who have control over the long run will have much greater chance or probability of success. In the end, though luck is a short-term friend or foe, skill shines through that long-term horizon. Like poker, investing and real life is based on making the best decisions you can from information that never can be complete. And here's an interesting statistic if you want to get into how skill plays a role in poker, and I would argue the same for investing. In a study done by an economist where he analyzed hundreds of thousands of hands played on poker websites, he found the actual best hand won on average only 12% of the time. So that skill certainly manifests itself. Those players who have the skill are able to wean the better hands out of the pot because they have the skill of being able to scare off those players who have the best hand and bluff them. Speaking of probabilities and chance, very often when we hear things like candidate X Let's talk presidential election 2016. Hillary Clinton, by most polls, was widely expected to win the presidential election. And most polls show that Hillary Clinton had somewhere between a 70 and 75% chance of winning the election. On average, it was about 71% probability. In our minds, when it's something that we are not financially vested in, 71%, with the way that we are wired, we often think of 71% as being close to a certainty. We're looking for an answer. We're looking for an outcome. 71% chance Hillary Clinton's going to win the election. In our minds, Hillary Clinton's going to win the election. That's what all the polls tell us. Every poll's telling us she's got a 70+% chance of winning the election. Donald Trump has a 29 or 30 or 35% chance of winning the election. He's going to lose. But when we think about those probabilities and we have to actually put our money where our mouth is, would you be willing to make a large bet if you had a 30% probability of losing that bet? Would you bet your life? Does it suddenly become an automatic? Does it suddenly become, hey, you've got a 71% chance of XYZ happening? Are you willing to bet your life on 71% chance? Odds are, when you start thinking about it, you got to put your money where your mouth is. That suddenly 71% doesn't look so overwhelming. Point is that while Hillary Clinton was favored to win the election, that Donald Trump winning the election was not nearly the shock of the magnitude of that event was not nearly as great as if you had looked at the probabilities and the polls and what they were indicating. In fact, the probability that Donald Trump did win the election was nearly 1/3, which is about the odds, if you think about it in poker, of flopping a pair on the first two cards that you draw. Something that you probably would not bet a huge amount of money against if you had to put your money where your mouth is. In fact, the one profession that has one of the greatest odds of assessing probability are lawyers who take cases on contingency. These are lawyers whose livelihoods depend on being able to assess the probability of winning a case, the probability of investing their time and resources and getting nothing in the end. Those people who do that for a living are people who have historically shown one of the best abilities to be able to assess the likelihood of probabilities and success. What's also interesting is, and many of you who have seen people participate in the market or participate in the markets yourself, perhaps by using risky strategies like options or margin, is that when you have success early, when we win at the start, that's when we lose objectivity and we see the illusion of control playing out in full swing. So make a large bet in the options market, you have success. Human nature is to start thinking that you have some form of control, you have some form of knowledge, that you are better than the probabilities. Losing early is often something that will translate into greater success in investing, because you recognize that you don't control events and they are outside of your realm of ability to change what's going to happen, and you become much more calculating in how you approach financial markets. So, I'm going to move on to financial markets now that we're versed in chance, probability, and control, in being able to make long-term, intelligent, strategic decisions. So let's take a look at financial markets this morning after a rocky week last week where we saw the NASDAQ sell off significantly with a few days of bounces in between. And this morning we are seeing futures to the upside. Right now, let me just get an update here. We're looking at Dow futures up about 230, S&P futures up 37, NASDAQ futures about 140, all translating into about a 1% move higher in the averages. In Europe, the stocks index climbed about 0.2%, and this optimism this morning is being fueled by a surge in deal making over the weekend, which is helping boost sentiment. Gilead Sciences, GILD, announced a $21 billion deal to buy biotech company Immunomedics, IMMU. Japanese conglomerate SoftBank has agreed to sell the UK-based chip maker ARM Holdings to NVIDIA for $40 billion. That sends SoftBank stock about 9% higher this morning. There are reports that software group Oracle has emerged as the favorite to buy TikTok's U.S. operations after Microsoft said its bid had been rejected, also contributing to the buoyant mood. Although there are reports coming out of Asia and China that they are rejecting the Oracle offer. That even though the Oracle offer is structured as a partnership, that the Chinese do not view it favorably. Also helping sentiment this morning, vaccine developments. Pfizer CEO saying the drug maker would know by October whether its COVID-19 vaccine candidate being developed with Germany's BioNTech will work. If successful, they said it could be distributed by year end. Also, the University of Oxford and British pharmaceutical giant AstraZeneca added to the positive sentiment, revealing that trials for their experimental vaccine will restart after being halted last week. Attention this week is going to turn to central banks as the Federal Reserve in the U.S., the Bank of Japan, and the Bank of England all meet later this week. In Japan, Yoshihide Suga is expected to be announced as Japan's new prime minister after winning the ruling party's leadership election. Yen has held steady following the news. He was the country's chief cabinet secretary and said he would not stop former Prime Minister Abe's economic reforms in Japan. Other news this morning, President Trump signed an executive order to lower drug prices. Congress is debating how to extend existing government funding. This is for funding the government. Republicans favor extending it until December. Some Democrats want to extend it into next year. This is to avoid the government shutdowns that we've seen previously. Recent polls showing that President Trump is trailing Joe Biden by about 7 points nationally, based on some recent polls, roughly the same as the previous week. Goldman Sachs and Deutsche Bank said they believe that the recent stock pullback is nearing its end. Yahoo Sports is reporting that the Big Ten football could return this fall. Amazon said that they will be hiring 100,000 new full and part-time employees across the United States. BP releasing its oil demand outlook, and they expect oil demand to remain weak to tepid. Delta Airlines said that their September 2020 system capacity is expected to be down approximately 60% compared to the September quarter. Speaking of airlines, United Airlines said that they do not expect travel to come back until a COVID-19 vaccine is widely available. Merck in the news, they are going to begin human testing for their coronavirus vaccine. And speaking of Merck is teaming up with Seattle Genetics, SGEN, to collaborate on 2 oncology studies. Merck is going to acquire a $1 billion equity stake in Seattle Genetics' common stock. Speaking of some of the excitement in the market this week, there are 11 IPOs that are slated to come public from some of the big bulge Wall Street firms. So the IPO market remains healthy, and we will see a slew of new stock this week. Google saying that they are setting the unprecedented goal to tap only renewable power by 2030. Becoming the biggest company in the world, committing to ditching coal and natural gas power. Google acknowledging that in order to achieve that objective, that we'll have to see technological and political breakthroughs in order to achieve that target. Taking a look at what we have to look forward to this week, Pfizer, who made some comments on their COVID-19 drug, starting today, is hosting a 2-day virtual investor day to discuss their pipeline of drugs. Tomorrow we get earnings from Adobe and FedEx. FedEx up meaningfully this morning, ahead of those earnings expectations. Tomorrow we get export and import prices for August. Wednesday we get the U.S. Federal Reserve announcing its monetary policy decision. Fed is expected to stand pat with interest rates near zero, but might expound on its recently updated inflation framework. Also Wednesday, we get the National Association of Home Builders with their housing market index coming out. Also Wednesday, we get retail sales for August. That is a critical number here to see how consumers are spending given the pandemic. Consumer spending is expected to rise 1.3% month over month. Excluding autos, it's looking to be up 1.5%. Thursday, we get Consumer Bureau reporting residential construction for August. Also, we're getting Labor Department initial jobless claims for the week ending September 12th. And then on Friday, we get leading economic indicators for August, looking for a 1.3% gain. And we are getting Consumer Sentiment, University of Michigan, all coming out this week. So lots of data, Federal Reserve commentary. So markets will have a lot to digest this week. Moving on to Barron's. Barron's saying that after the correction in the NASDAQ, about a 10% pullback, that they feel that the market is frothy, but they do not see an end to the bull market yet. They do expect some rotation. Cover story of Barron's article entitled, "Yes, it's a stock market bubble. That doesn't mean trouble for investors just yet." Why do they feel that this market can continue to move higher? One, near zero interest rates, encouraging investors to pay up for growth. We are looking also at a continuation of retail investors being starved for something to bet on in the absence of easy access to professional gaming and still not a full resumption of professional sports. Those individuals have turned their attention to stocks, trading online, and even as sports return, the expectation is the participation in the markets will continue at least until there is a more meaningful setback. Article states that the forces that drove stocks like Apple, Amazon to astonishing heights, that those forces remain firmly in place, as well as the Federal Reserve's determination to do whatever it takes to keep the economy afloat. Talked about retail investors' participation in the market. All those forces will keep stocks volatile, but Barron's suggesting it will enable the bubble to stay, and this is their words, the tech bubble will continue to inflate. They say from an investment bubble to occur, there has to be a widespread belief that a new paradigm is taking hold, requiring an adjustment in valuations far beyond what previous fundamentals would imply. That belief needs to engage the imagination of investors beyond Wall Street, and there must be plenty of capital to chase stock prices higher. And the COVID-19 crisis has unlocked all of those prerequisites. As a result of the excitement and ebullition in the market, we have seen companies that have business models that are thriving in the current conditions, like Apple, Amazon, Microsoft, Apple, and Facebook. Those companies thriving and now represent a quarter of the value of the S&P 500 index, which is a concentration that's rarely seen in just 5 stocks. If you add Amazon to that mix and the S&P Information Technology and Communications Services sector, you put those together with those 5 stocks and you get a S&P benchmark representation of 45%. If you were to look at the similar representation in the 1999-2000 bubble, we'd be looking at representation from a similar basket of stocks of about 40%. So we are exceeding that, but nevertheless, we're exceeding that with companies that have more earnings and better prospects for their business models. Is what Barron's is pointing to for the reason that they remain cautiously optimistic for the near term. They say that there are certainly certain sectors that look frothy. Zoom trading for 50 times 2020 sales. Peloton trading at 9.3 times sales. Both stocks are prices if the future growth is unlimited. They say that's a risky bet, especially if you think that at some point the world will not end in us all living in our homes and wearing masks for the rest of our days. What is interesting is that retail trading now accounts for 44% of trading. That's up from 25% in 2009. That is something that is cautionary. But again, Barron's not expecting that to change in the near term. The real driver of the expectation that the markets can continue expanding the bubble, or the bubble machinery, as Barron's calls it, is the Fed. The Fed has pumped trillions into the economy, expanding its balance sheet to $7 trillion from $4.1 trillion at the start of 2020. What has caused past bubbles to burst, including the dot-com bubble and the housing bubble, were both rising interest rates, and the expectation, which has been reinforced by Chairman Powell, is that the Fed doesn't have any intention of raising interest rates from these extremely low levels at the current time. Also, if you look at the ability of the U.S. to service its debt, the ability to service the debt because of the extremely low interest rates is near historic highs. So despite the fact that we have piled on trillions of dollars in debt, the ability to service that debt remains very achievable because of those low interest rates. So higher interest rates causing several problems if they were to occur. One is that the deficit would be very difficult to service, and of course, secondarily, future earnings would be discounted back at a higher interest rate, meaning that PE multiples may expand. And thirdly, we'd have competition from bonds for stocks to earn income. So really, the key focus here is to keep your eye on those interest rates, and you start seeing them tick higher. That would be a reason to really start getting worried. Until that happens, Barron's feels that the party will continue to go on, although the nature of the party, they say, will shift. And that leads me to their next article, which is Wall Street strategists say there are a few gains ahead for the S&P 500, but what they expect. And this is a separate article in Barron's where they had a poll of 5 Wall Street economists, BlackRock, Goldman Sachs, Morgan Stanley, Nuveen, and Bank America. They talked with the head of investing, and they asked them for price targets for the S&P for 2020, 2021. In general, seeing S&P targets for 2020 around 35 to 3,600, not too far off from where we are here. And for next year, about 3,800, which is about 15% higher. But what's interesting is that the expectation is that they expect there could be a rotation from new economy to old economy. So there could be a rotation out of some of the technology stocks into some of the stocks that would be in the industrial space that would be beneficiaries of a post-COVID world. The Goldman Sachs strategist Costin said a sustained rotation from growth to value is a recipe for relatively flat performance on the index. This article also goes to talk about the situation with interest rates and how interest rates are critical for the markets to remain buoyant. But it goes on to talk about some other factors that can contribute to low interest rates. One of them is the population here in the United States, as well as in developing economies, that continues to age and prioritizes saving. Technological innovation, which continues to bring prices down, as we see with Amazon or even Peloton. Compare that to the cost of your gym. Your whole family could work out on a Peloton for one price. And global supply chains, which are keeping a lid on inflation and therefore on interest rates. This therefore creates a conundrum of where to find income. These strategists suggest that starting next year, they think there may be a rotation into traditional dividend-yielding stocks like utilities. They also suggest taking a look at preferred stocks, and specifically bank preferred stocks like J.P. Morgan, Bank America, which have yields of 4.5% to 5%. And the article highlights taking a look at the iShares Preferred and Income Securities Fund, PFF. It's an exchange-traded fund owning bank prefers that's yielding about 5.4%. I'll quickly mention 3 companies mentioned in Barron's, then I'll turn things over to Brad. Barron's talked about 2 companies that would qualify for the cyclical category, have been largely out of favor, that they spoke positively about. One is Crocs, symbol CROX. You may remember them for making those resin shoes that you see people wearing around. They're known for their comfort. And Barron's pointing out that Crocs are seeing a resonance or a resurgence here in the pandemic world. People looking for comfort, for low cost, for ease, slip on, slip off. And Crocs has made some technological innovations in their product as well. They're also very popular with frontline healthcare workers. Crocs has given away almost 1 million shoes to frontline workers, and they have started reciprocating that appreciation by buying more and more Crocs as they like them. Crocs is also expanding in Asia and China, and the stock, which trades at around 20 times earnings, is trading around $40 to $45 a share. Barron's suggesting over the next several years the stock could trade up as high as 75. That's a several-year price target, not a 12-month target. Another company mentioned very favorably in Barron's, General Motors, another one that has been largely out of favor. And this article suggests that General Motors, if you look at the sum of the parts, their electric vehicle business, their self-driving business, their traditional legacy automotive business, if you sum it all up, you could see a price that could be double the current price. Barron's goes on to talk about that the analyst community believes General Motors can achieve higher stock prices. 90% of analysts covering the company's shares rated a buy. 55% of the average stock has a buy rating on it. So General Motors remaining in favor with analysts, but not so much with individuals. We'll see if that changes. Barron's cautiously optimistic. And then finally, one that is not a cyclical, that is not out of favor, is Microsoft. Microsoft launching their new Xbox Series game, and Barron's talking about that they are coming out with some new pricing options to turn gaming into more of a subscription service. One is to finance the new system for $35 a month for 2 years. And with that subscription, you would get access to Microsoft's and EA's online game catalog, giving gamers access to hundreds of games at no additional cost. Microsoft also coming out with some other subscription services where you purchase the hardware, but you can subscribe to the software. One is a skinny version that has a low price point. The other is a more expansive version of games that has a higher price point. So video game business for Microsoft growing about 10% a year over the last 3 years, now representing about $11.6 billion in sales. So no longer a peripheral business for Microsoft, and they are taking action to try and monetize that cash flow like they did with Office 365. That's it for me. I went a little bit over. Going to turn it over to Brad. Good morning, Brad.
Morning, Keith. Hope everyone had a nice weekend. Welcome back to these unbelievable markets. Volatility like we've never seen before. It's funny because I've personally been pretty quiet on the fixed income side, specifically municipals. Municipals are still the cheapest bond for a taxed account on an after-tax basis. We're talking about 200 to 300% of where the prevailing treasuries are, but the absolute rates of return are too low for many investors to really digest. Talking about longer-term bonds breaking down below this 2% bogey, so to speak. A lot of people just don't want to lock in their money for 1.9% tax-free to a 10-year call, even though the 10-year Treasury is at 0.65. So the percentages are tremendous, but the mentality is that it isn't worth locking the money up for that long period of time at those levels. That all being said, it's very interesting. During times of equity turmoil in the past, a lot of this money would have come back to fixed income, but it seems that everybody, or a lot of people who I speak to, want to keep money on the sideline for equities, for sell-offs, and that is what is fashionable right now. No one has the crystal ball to have the answers, and you just have to make sure that you're comfortable with what you have and that you are ready to weather any storms or participate in any upside in any of the markets. What I'm what I'm seeing is, and what I'm seeing in the municipal bond market is that there are going to start to be some downgrades here. The MTA was just downgraded by Moody's from A2 to A3. That is the kind of downgrade that I'm okay with. I don't want to see downgrades from AA to BBB. That would be concerning to me. I hope that we can avoid that. As we see traffic picking up locally, as we see other economic activity picking up, and if we wind up getting good fiscal management on the governmental side, there is a possibility that the downgrades that will happen could be one tick. One tick is not a problem. It gives an opportunity for the issuers to still come to market at these low rates, and it's the 2 or 3 tick downgrades that concern me, and I hope that we don't see that. What I want to see? I'd like to see an opportunity to have a better opportunity to invest municipals with a supply and demand mismatch, where it happens 2 or 3 times a year, where the market just can't absorb all the municipals that come to market. What's happened recently, though, is because of the newer tax laws, a lot of the issuers have been coming through the taxable market. So you've had a lot of taxable municipal bonds, which don't pay a lot more than the tax-exempt bonds. But it does fit a broader market because there's a lot more tax-free investable money from pensions and other sources that need that taxable income. So as we see more issuance, we could see better rates if the demand doesn't pick up. And I do see some individual investors balking at these rates, and usually the investors balk at the rates for a little while, but sub 2%, we could see that for a little while longer until we get back to above 2% or even closer to 2.5%. A spike, the other thing I'd like to see is I'd love to see a spike in longer-term Treasury rates. It is possible that it could happen. The Fed controls the front end of the curve, and obviously it's important, as Keith had mentioned, that the government can borrow money very cheap, and they'll be able to borrow that money short-term in short-term bonds, and those rates are close to zero. But as things get back to normal, hopefully, we could see an uptick in 10-year treasuries and longer. I don't think it would be unreasonable to think that we could move on a 10-year from 0.65 to 1%. I still think that would be an extremely low rate. And on the 30-year, we're at 1.4 right now. To see that go to 2% still would be one of the lowest historical rates. So we're just in uncharted, unprecedented territory here as far as our rates are concerned. This is going to be a very interesting period coming up in the next few months with the election and COVID, and to see how the country responds to everything. So my opinion is to be nimble, be ready to make adjustments to your portfolio on any extreme moves, and watch what's going on locally in your economy to get a feel of a pulse of the economic activity, and also to keep an eye on the headlines, because there is certainly going to be volatility coming up. And that's all I have for today. Thanks, everyone. Have a good week.
Thanks, Brad. Thanks for the update. Also, some other news that has taken place. Treasury Secretary Mnuchin, on a CNBC interview, said he's open to speak with House Speaker Nancy Pelosi anytime regarding stimulus. He's not going to speculate if stimulus gets passed. He confirms the U.S. got a proposal for TikTok from Oracle. Also, in the M&A front, TracFone being purchased by Verizon for a little over $6 billion. Verizon stock moving up on that announcement. Also, Oppenheimer raising their target on Apple to 125 from 105 this morning. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.